We hear about the higher rates out there right now, but what are tactics to help you get an edge on your loan? What if you can buy a house with a 30-year fixed mortgage and pay a 2% lower interest rate in the first year and a 1% lower rate in the second year? How much would that help you secure that loan for your dream home? By requesting a reasonable concession from the seller, this is possible today, and it's becoming more common because we're in a higher interest rate environment. This is called a 2-1 buy down. Now, before I start, keep in mind that if you're looking to buy, sell, or invest in real estate in the Bay Area, my team would love to be your trusted real estate resource. Call or text us at 408-547-4590, and we can set up a time to go over a strategy call today. And don't forget to subscribe to help us hit 5,000 subscribers. So the 2-1 buy down is becoming much more popular in today's market than it was before. Why? Because there's mutual benefit to be had. Buyers get into their new house, keeping thousands more in cash in their first and second year, while sellers help facilitate a quicker sale. Sellers, including home builders, know it's a little slower for the real estate market, and they also know a lot of capital has been impacted due to lower valuations of their stock or in their crypto accounts. So how does this 2-1 buy down work exactly? Whether by a buyer's request or a seller's initiative, the discussion will arise. The seller agrees to supplement the buyer's mortgage payments the first 24 months of their residence in their new place. The so-called 2-1 comes in because during the first 12 months, the seller pays down the buyer's monthly interest by 2%, leaving the buyer with, for example, 5% interest to pay on a 7% interest loan during that time. During the second year, the interest savings decrease to 1%, and the third year, the effective interest rate returns to normal, the amount that you're locked in on the 30-year loan, assuming you're doing a 30-year fix. Now, there are also these 3-2-1 buy downs. It's really the same concept. It's just a higher incentivization from the seller over a longer period of time. Now, these are both known as temporary buy downs. The lower rate lasts only a few years, whereas with a permanent buy down, the lower rate lasts for the term of the mortgage. So there are options there that you can also consider. This temporary buy down strategy can potentially save the buyer tens of thousands of dollars over a 24-month period. And you can see why it's more popular now. Now, what if rates decline during this time? If your finances can work, you can refinance out just like any other loan product. If rates drop by 1%, just go refinance into a standard 30-year fix. Locking that in, and the capital that was initially provided by the seller can then be recouped. Now, there is an important note. The buy downs are only available on conforming loans, and usually for new mortgages and not refinances. Thus, if this is like many of our jumbo loan homes in the Bay Area, this wouldn't work. But it's a fantastic tool for many of you first-time buyers out there. Have you or anyone you know ever used a buy down? If you're thinking about listing with a 2-1 buy down offer, or if you're buying and are wondering how you can work a buy down into your purchase, let's definitely talk. Set up a time to chat with me by texting the number or visiting the calendar link in the description. For weekly Bay Area living and lifestyle tips and to learn how to successfully buy, sell, or invest real estate in the Bay Area, like this video, subscribe to my channel, and let's connect on Instagram at Bay Area Tech Realtor. See you next time.